Hello there, Dana here with another Thursday trade recap. Today I will demonstrate the SPY gap fill up strategy that SPY presented this week, the week of February the 3rd. On your screen, you see SPY, which is the S&P 500 ETF. It is shown on the 1 hour time frame. This is simply so that you can see the pre-market. But of course, if you combine the 1 hour candle sticks from January the 31st, it gives you the full day of price movement. And you know how to read a candlestick based upon our previous videos. You have the open price, the closing price, the highest price, and the lowest price. In terms of the price data for that time frame. The lowest price is really what we need for this strategy. The pre-market gave us the opportunity to plan for this trade, and this is the pre-market the morning of February the 3rd. And you see there's a gap. Based upon the pre-market data, the SPY price, it was poised to open around $593. And that's about $8 less than this lowest price on Friday, January the 31st, therefore creating the trade opportunity for a gap fill up. This strategy is based upon probabilities that price will retrace to refill a gap, such as what I just described. This creates a short-term bullish opportunity because we believe, based upon this information, that SPY price will increase from 593 at least back up to $601. So our target for this trade opportunity would be the $601.05. So let's see how the trade unfolded. The morning of February the 3rd, we see that SPY price opened around $593. Under the strategy, I selected the 595 strike price. Why? Because to increase my probabilities of a profitable trade, I always select a strike price, which is in between the price of my ticker at the open for this strategy and the potential target price. I also buy time. February the 7th is when this expired for approximately $401 per contract. Moving on to February the 4th, we see that we reached our target. We filled the gap, meaning that the price of SPY increased to $601.05 to fill up that gap. Based upon the strategy and my parameters, that means this trade is done. So the contract was selling at about $812 per contract at this time. You can do that math. For this trade, you are in profit about $411 before taxes and fees per contract. Whether you purchase one contract, 10 contracts, or something else, you've got $411 profit per contract, and that's about 102% profit. I'm sorry, 102% return on investment before taxes and fees. So, takeaways for this particular strategy. What I like about the gap fill up is that you can plan it before the cash market opens. That way, you are not swayed by the volatile movements when SPY first opens. You can identify your entry point, you can identify your trade exit, you can also identify your strike price as well as how much time you want to buy. In order to manage this trade, you also need to know your stop loss and when you will exit this trade when you first receive evidence that the trade is not moving in your favor. Because as you know, options trading is about probabilities. I am unaware of any strategy that is 100% profitable every time. I'm just not aware of it. By setting parameters, trade management, and stop losses, you will be on your way to being a consistently successful and profitable trader, even when a trade does not go in your favor. I hope this is helpful to you. Until the next time, take good care. Goodbye.